A piece of industrial equipment decays in a way you can track. The metal rusts, the parts wear down, and the physical degradation maps predictably to its declining value on a balance sheet. Digital assets do not rest. A codebase can look pristine and function perfectly, even as its commercial value evaporates. User activity flatlines, protocol shift, and market relevance vanishes overnight. This creates a severe structural problem for financial reporting. Massive intangible balances, like goodwill, capitalized development costs, and acquired software, often sit fully valued on the balance sheet, completely detached from their underlying economic decay. The International Accounting Standard 36, or IAS 36, is designed specifically to catch this detachment. Its purpose is to force financial realism, requiring management to write down assets when their recoverable economic benefit drops below their carrying amount. Yet, financial professionals frequently misapply this standard by treating distressed digital ecosystems like aging factories. To accurately assess digital assets, we have to examine three specific failures: how trailing financial indicators mask operational distress, how boundaries around cash-generating units are manipulated to hide toxic assets, and how the measurement rules of IAS 36 interact with other accounting standards. Waiting for a digital asset to visibly break results in delayed, massive write-downs. That destroys market credibility and exposes a total collapse of management discipline. Under IAS 36, an indicator of impairment is a specific signal that an asset's value fell, requiring an immediate formal test rather than waiting for the annual budget cycle. This chart shows indicator lag. Financial metrics like revenue and EBITDA remain artificially stable, while operational data drops rapidly. The earliest distress signals appear in unit economics: rising customer acquisition cost, dropping net revenue retention, and mounting technical debt. External pressures accelerate this. A sudden privacy regulation shift, a new open-source standard, or a faster AI competitor can instantly destroy an asset's viability, even with untouched code. This distress is cumulative. A slight increase in cloud hosting costs, combined with a 3-month delay in a product rollout, quickly compounds into deep structural deterioration. Management teams often respond to this deterioration with a grand strategic narrative, promising future pivots or hockey stick recoveries. IAS 36 rejects this optimism. It demands hard, observable evidence to justify the carrying value. If unit economics break at the operational level, the present value of future cash flows is already impaired. Management's financial optimism cannot override the commercial data. Once indicators trigger a test, IAS 36 dictates exactly how that test is applied. Assets must be evaluated individually unless they do not generate independent cash inflows. In the technology sector, testing a single asset is almost impossible. A recommendation engine, API gateway, or shared codebase rarely generates cash on its own. They are deeply intertwined within a larger platform ecosystem. Because of this interdependence, testing moves to the cash-generating unit, or CGU. IAS 36 defines a CGU as the smallest identifiable group of assets that generates largely independent cash flows. This shows boundary inflation. A single red node represents a failing software module. By drawing the boundary wide enough to include healthy green nodes, management merges the failing asset into a profitable ecosystem, creating artificial accounting headroom and turning the group green. This happens very routinely in corporate acquisitions. A company might buy a mobile app that rapidly loses users, but because that app shares back-end cloud infrastructure with a highly profitable enterprise software tool, management groups them into a single CGU. This overly broad grouping allows the strong cash flows of the enterprise tool to absorb and completely conceal the toxic mobile app, allowing the obsolete asset to bypass auditor scrutiny. The standard explicitly forbids this. CGU grouping must follow how economic cash actually enters the business from customers. It cannot be based on internal engineering charts or segment reporting convenience. A poorly defined boundary invalidates the entire impairment model from step 1. It acts as an accounting shield, sheltering obsolete technology from necessary write-downs. Establishing the correct boundary brings us to the measurement phase. And IAS 36 impairment test does not operate in a vacuum. It sits within a strict interlocking accounting architecture. IAS 38 governs recognition, placing the asset on the balance sheet, but this offers no protection against future commercial irrelevance. IAS 36 enters as the second layer, checking if the recognized value is still economically justified. Recoverable amount is the higher of value in use or fair value. Value in use is an internal forecast, susceptible to management's optimistic bias. To strip away bias, we apply the third layer, IFRS 13 fair value, asking what an external participant would pay. To reach the final figure, we have to calculate the costs of disposal. For technology assets, this requires deducting the massive expenses of data migration, legal separation, and code disentanglement from the fair value. If obsolescence and massive disposal costs drive the IFRS 13 market value near zero, management's rosy internal value and use model demands intense skeptical audit scrutiny. A rigorous impairment roadmap is sequential. It starts by identifying operational triggers, moves through strict scoping and measurement, and ends at the exact allocation of the financial loss. But the entire exercise ultimately culminates, and frequently fails, in the public financial statement disclosures. Distressed tech companies often hide behind vague, boilerplate language in their footnotes. Simply stating that assumptions are reasonable destroys market credibility and actively obscures the true risk to the investor. Rigorous IAS 36 disclosure demands specific, quantified sensitivity metrics that expose the exact fragility of the valuation model. Financial statement users need to know exactly how close a digital platform is to a massive write-down if a single key assumption, like the discount rate or a renewal cohort, shifts even slightly. IAS 36 is not a mathematical ritual used to defend past acquisition costs or to validate management's original investment thesis. Rigorous impairment testing is a strict framework for confronting economic decline. It forces the balance sheet to reflect the hard commercial reality of the business today, stripping away the technological optimism of yesterday.